And yes, it works. I recently helped a couple who used this exact strategy, and based on their income and spending habits, they're on track to pay off their entire mortgage in just 6.7 years instead of 30 years. So in this video, I'm going to explain exactly how this loan works and why it's different from a traditional mortgage. Let's start with how a traditional mortgage works. You borrow a lump sum, say $400,000, and you repay it with fixed monthly payments over a long term, typically 30 years, because mortgage interest is paid in arrears, meaning you're always paying the last month's balance. The principal declines very slowly, especially in the early years. That's why in the first 10 years of a 30-year loan, most of your payment goes straight to interest, not principal. For example, on a $400,000 loan at 6.5%, you'll pay roughly $510,000 in interest over the life of the loan. That's more than the amount you borrowed. Here's why this product works differently. It's called a First Lien HELOC. It replaces your traditional mortgage, but it's not a second loan or home equity line sitting on top of your mortgage. This is your mortgage, and on top of that, it acts like a checking and savings account all in one place. With a First Lien HELOC, your income deposits directly into the loan account itself. Every dollar that hits that immediately reduces your principal balance. And since interest is calculated daily, your balance means less interest occurs each day. Your expenses are then drawn out of that same account as you live your normal life. You have the same features as traditional bank accounts. So your balance goes down when your income comes in and slightly back up when you spend. This simple change in how your cash flows can shave decades off your mortgage. While with a standard mortgage, your money sits idle in checking and savings accounts, earning next to nothing. Meanwhile, your loan balance keeps accumulating interest daily or monthly. So here's a real life example. A couple I helped earned about $15,000 a month combined after taxes. Their monthly expenses are roughly 72% of that income, which means they keep about 28% or $4,200 each month as positive cash flow. They decide to use a First Lien HELOC instead of a 30-year mortgage. Every month, their income deposits directly into their loan account, reducing the balance immediately. As they spend through the month, like pay for bills, buy groceries, the balance rises again. But most of the time, the balance stays lower than if it were a fixed loan. Because interest occurs daily, they're paying less interest almost every single day. That daily efficiency compounds. And now they're projected to pay off their mortgage in just 6.7 years, saving roughly $386,000 in interest compared to that traditional mortgage. No, it's not magic. It's math and structure. You're not changing your income or lifestyle. You're simply changing where your money sits. Now, obviously, it varies depending on your monthly deposit amount, leftover funds, loan amount, and how consistent your cash flow is. But the concept remains the same. The more your income stays in the account, the faster your balance drops and the less interest you pay. This strategy works best for people who have consistent positive cash flow, meaning your income is higher than your expenses every month. It's also ideal for financially disciplined borrowers who want to get ahead faster without losing access to their equity, because with the First Lien HELOC, you can still pull funds back out when needed, unlike a traditional mortgage where your equity is locked away. As of today, most HELOC-based loans are around 8%, give or take, depending on credit score and loan amount. Now, don't focus too much on comparing the interest rates, 6.5% versus 8%, because These are completely different loan structures. Can't compare those apples to apples. The all-in-one loan calculates interest daily on the balance that's consistently dropping. That efficiency more than offsets the rate difference. So yes, this strategy works. That couple I mentioned will be completely mortgage free in just 6.7 years, not because they make more money, but because they changed how they manage it. So if you wanted to see whether this strategy could work for your situation, drop me comments and I'll help you find your projected payoff timeline. See you in the next video.